well. I mean, this 1% should have showed up on, by 3 o'clock on Friday after the sovereign upgrade. But there was absolutely a whimper of a response, nothing at all. But it's showing up this morning after some of this good news has accumulated. Heat map on your screen. I think all of it except two names are in the red right at the start. And autos is the big one. Hero, Maruti, Bajaj, and of course a bunch of other stocks out there as well. 300 points in the Nifty. Surabhi.
Absolutely brilliant looking screen. Look at that. It's all green, barring two stocks on the negative side, and big gains. Hero Moto 8%, Maruti 6%, Bajaj Auto 4%. And then come in the consumer names, because remember, most of the everyday essential items, that's what our consumer almost 3% higher. And if there's so much of consumption happening, then perhaps it rubs off on lenders as well. So look at Bajaj Finance, look at actually everything in financials is up and about. Shriram, everything is up and about. Hardly any stock on the negative side. Relatively speaking, IT is obviously the weaker of the lot this morning. TCS Wipro flashing a little bit of red, HCL Tech slight red, and L&T is very, very flat. But otherwise, what a glorious start to the week.
Well, it's a bazooka liquidity, and the FIs are aggressively net short. So this sort of a gap up, if it sustains, it's going to force those shorts to cover out. Good start to trade, and the Nifty Bank as well moving to that 20 DMA. So the Nifty's already crossed the 20 DMA. The Nifty Bank moving towards that mark. If we're talking about autos, take a look at consumer electronic companies. Voltas, I think it's circuit up 10%. It's locked the last time I checked. Just pull up that name. Blue Star's the other one that's up close to around 8%. So big move is what we're seeing on these names. And PG Electro Plus, remember they went ahead, they cut their guidance. The street was very, very skeptical. There are a lot of shorts in the system. That one's opened up with a gain of around 8%. So that EMS player as well is participating on the upside. From the FMCG names, Dabur, that's the stock that's up more than 5%, and volumes are very, very high on that name. So big up move is what we're seeing, still holding with a gain of around 5%. Zaggle reacting to its numbers, positive reaction out there, stock flying away up more than 6% as we speak. Niva Bupa, that's a stock from the insurance space that's holding with solid gains, so good move out there. And Ola Electric, they launched a new motorbike over the weekend, and it looked quite good. We'll have to see how performance shapes up on that one, but first look at it was pretty good. So that stock, in fact, is up and about in today's trading session. Volume's quite high. It's more than 100 rupees away from the highs that we have seen post-listing, but that one's in fact higher. Just one stock on the downside. I think Kaveri Seeds came out with a set of numbers, and that stock is losing out. It's down close to around 6% as we see.
Right, 300 points on the Nifty, 24,945 is where we are at. It's all GST. I mean, the promise of GST rationalization showing up in a big way. And of course, autos is the big winner. Maruti 6%, Hero 8%, Bajaj 4.5%, TVS 5%, Ashok Leyland 4.5%. So Hyundai is up about 4.5%. So kind of rising tide lifting all boats, right? But there is... the AC names, Amber, Voltas, PG Electro Plus, 5 to 8% gains here. 5 to 9% actually. Voltas is up 8.5%, 9% now. So that's the other one. Havells, you can throw in the lot. Durables, right? Havells is up about 4.5% as well. Dalmia Bharat is coming up with a 4.5% pop. In the durables, AC pack 6.5% on Blue Star as well. So yeah, I mean, it's, pure staples, which is, the lever, and except Dabur, I can't really spot very much else, which is up in a big way. Maybe there are one or two, but Dabur is clearly, which is up about 5% right now. From the pure staples sort of side of things at this stage. 2,000 stocks are higher, and we've got about only 400 stocks which are lower at this point. 40% on Sin Goods, right? Godfrey Phillips is down 4%. It's the largest volume-led loser on the NSE right now. Volumes are not very large, but 9,800, 36,000 shares on Godfrey Phillips at this point coming through. I mean, for a player like ITC, it kind of balances out because, they got such a large non-cigarette portfolio. So I guess there is that which is happening. So it's that kind of unchanged ITC at this point in time. So more coming up a little later. Ashwini Agarwal is with us, founder and partner at Demeter Advisors. Ashwini, good to have you with us here. Good morning. Do you think it's these GST cuts, bulk of things moving to 5 from 18 to 12? It'll provide that much-needed durable lift to consumption, Ashwini? And which segments do you think are likely to benefit the most, in your opinion? The mass level, or still it's going to be the premium end?
So Prashant, just last week somebody was asking me, I don't know who it was, I can't recall, as to what would you wish for in terms of reforms, and I was saying that it's about time that the GST system is simplified. Number of slabs brought down to 2, which was promised at the time of the of the rollout of GST. And to my mind, this is a very welcome move. So I think all categories will be impacted, more so on the staple side, where the consumer is a little more price sensitive, and low-end autos as compared to the premium side, because the premium demand is not really that price sensitive. Having said this, I think the biggest benefit from this is going to be fewer controversies, fewer disputes with the department in terms of what tax is owed to the government. Hopefully, the simplification of the slabs will remove, that ridiculous example of popcorn, whether it is salted or caramelized or buttered, being charged at different GST rates. So I think that simplification adds to the ease of doing business, and that to me is a very, very big positive, in addition to probably stoking demand at the lower end of the price curve.
Ashwini, hi, morning.
Morning.
Yeah, indeed, that was quite the GST meeting. Infamous for the caramel versus salted popcorn, right?
That's right.
But yeah, this is far more meaningful, what we're hearing, what we're understanding right now. So from a market perspective, how do you play it? Do you go into staple stocks? Do you look at buying beaten down four-wheeler names? No one's been buying stocks like Maruti and Hyundai for a while, right? So how do you as an investor navigate for this new GST regime?
So, interesting question. I'm still trying to get my head around it. Autos has obviously been appreciated as a sector for a while. There have been no takers for it. And this might provide a rally for auto stocks in the near term. Medium term, we have to see if the demand revives. Now, zooming out, if I look at it, there are 3 or 4 factors at play. Number one is that liquidity and interest rates are far more benign now as compared to a year ago. Your inflation statistics are still telling us that there is no worry on the inflation front. You have a serious reform which promises to lift consumption. And hopefully, you have that additional 25% tariff on India going away at some point. Maybe not right away, maybe 3 months from now, 6 months from now, I can't say. Unless, of course, the US administration has singled India out for some punishment, which is possible. But I think, given how things are going, it's I would say that at some point in time, that additional 25% tariff is going to go away. So if you take all those 3 things into account and take the correction that's already behind us and look for a demand recovery 6 months down the line, that's overall positive for any consumption-driven stocks, whether it's auto, whether it's staples, whether it's domestic white goods, cyclicals, etc., etc. So I think overall the factors that are lining up for a more positive second half of this fiscal year are more than the headwinds, and that would appear to me to be the case as of now.
Hi, Ashwini.
Yeah, sorry.
Go ahead, please.
Yeah, and how am I looking to play it? I think, financials is still the best because, if demand picks up, then you should see an improvement in loan growth. You should see improvement in deposits growth, because deposits growth and loan growth are interlinked in a sense. And spreads are stable, funding is adequate, and hopefully no new loan losses will arise, and the stress on the microfinance sector will decline. So that may be an area that will continue to do well. At least that's what it appears to me. Yes, Nigel.
All right, Ashwini, hi, good to see you, Win. First, tell me what's on your wish list again? Because it appears your wish list get ticked off, so that's good. And, within the financials, what do you like? Some of these large private sector banks that actually underperformed, case in point being an HDFC Bank, they actually outperformed in the last few months or so after underperforming for the last few years. What is your preference out there, private versus public banks, and also in the NBFCs, what do you like? Gold companies, suddenly, you had a blowout quarter coming in from Muthoot. Do you like that? Do you like the housing finance? What would be on your pecking list?
NBFCs as a starting point. I'm a value investor, remember, and so that tells me that NBFCs are undervalued at this point in time. Probably a lot of the stress is already priced in. If the second half promises to be better on credit costs, then I think in some cases you could see valuations move up from being at below book to maybe 1.2, 1.4 times price to book. That would still be a far cry from the 3+ time price to book that many of these NBFCs enjoyed as early as a year and a half ago. So that would be the first area of preference for me, especially the beaten down names. And the second would be, I would guess, the PSU banks, because, if you look through the results of the PSU banks, they've shown that they've proven to be nimble. I mean, the largest of them being the nimblest of them. And valuations are, again, very reasonable. If there is a broad-based growth, then I have no doubt in my mind that the PSUs will participate in that growth. And going back to a principle I always like, that when growth is abundant, valuations come into focus, and when growth is scarce, then quality growth come into focus. So if we build a case that growth is going to be reasonable pretty much across the board second half of this year with credit costs under check, then I think valuations be the focus, and that's why PSU banks over private sector would be my argument.
Got it. Ashwini, just a thought experiment. If these rates, auto rates come down, right? Do you think an entry-level car gets more of a boost or an SUV? Prices go down for both.
So it's a question of, where the consumer has moved to. The market globally has moved to SUVs. So it's not just India. Globally, SUVs is the preferred vehicle. And therefore, if the affordability on an EMI basis increases, it increases across the board. And that preference for SUVs is not going to decline. Having said this, there might be some first-time buyers who might find that accessing their first car becomes a little more affordable with lower rates and with GST cuts, and that might egg them on. We still have to see the GST cuts come through and when they become effective. So that's just a note of caution. I mean, we are all getting very excited, but there is still a lot of fine detail that's to become available.
I just hope there is no slip between the cup and the lip in that sense, right? That's always a thing. By the way, Maruti hit almost 14,000 rupees. It's come off about 250, 300 rupees from the highs. Actually, across the board, and that's to be expected. There is a little bit of a pullback, not very much. Still strong gains through and through.
Yeah, absolutely. By the way, one more category which is being widely discussed and debated is hotels where the average room rate is below 7,500 rupees. And there the hope and expectation is that the GST rate will move down to just 5%, as nominal as that. And that explains in parts why not so much Indian hotels, but a Lemon Tree, for instance, yes, that's the stock, 5% higher this morning. So, big moves coming in over there as well. Just very quickly, this space, Ashwini, anyway, hospitality has been doing so well, right? Decent gains, good wealth creation over the last 1-2 years. Do you like anything here? And would you play, again, some of the more mass category offerings out there, or largely on the luxury side of it?
I actually like, airline stocks here, because I think on a sustainable basis, I thought that, Air India would set the cat among the pigeons, the takeover by the Tatas, but that unfortunately, for a variety of reasons, hasn't happened. The market continues to exhibit significant pricing power. So that's one. And even in the hotels industry, while a lot of capacity is coming on, the capacity addition lags demand. And my sense is that these two will continue to benefit from the domestic demand and shift in consumption patterns that we've seen. Obviously, if the GST rate for hotels below 7,000 rupees go down to 5% and above 7,000 go to 40%, you would expect some consumers to shift. I mean, the price differences would become very stark. And I imagine that in some cases, some of the kind of premium properties might need to look at their rates to reduce the gap in pricing. So at the margin, I think, yes, this is not so great news for premium 5-star properties, and stocks might take a bit of a knock. Again, Surabhi, I'm not prepared to pull the to make a call on this right away because we don't know what the fine print will finally say on GST.
Okay, all right. Ashwini, we'll leave it there. Thank you very much for joining us. Good speaking with you, and thank you for taking out the time. Have a good week. The markets, of course, holding with anything between 4 and 7-8% kind of gains across a whole range of auto names, AC names, and to a lesser degree, some pure consumer staple names as well. But that was to be expected. There are these, I spotted Dalmia Bharat earlier, but there is Shree Cements, which has also come up now, 4% gain. So cement is also, one or two additional names that are showing up with regards to the moves that we have. Auto and consumer durable stocks are surging. And let's just revisit the thesis which the street seems to be making. Let's talk about auto first. So over to you.
These auto companies have suddenly come out of the city traffic and moved to expressways, and they are moving in the highest gear. So first, talking about two-wheeler stocks, why they are higher. So all the auto names currently are in the two tax bracket. First is 28%, or second, it's higher than 28%. So for the two-wheelers having the engine capacity up to 350cc or equal to 350cc, for them, tax, that is GST tax rate, can be reduced to 18% from the current rate of 28%. And two of the biggest beneficiaries of those can be first Hero MotoCorp, for which 95% of total domestic sales are in this bracket, that is 28 to 31%. Second, the biggest beneficiary can be Eicher Motors. Many people believe that they have most of the vehicles which have higher than 350cc, but that is wrong. So 86% of their bikes have the engine capacity up to 350cc or less than 350cc. Even Bajaj Auto and TVS Motor will benefit. For Bajaj Auto, 52% of the domestic sales are in this category, and for TVS, almost 70% of the total sales of domestic sales are in this category of 28 to 31%. As far as four-wheelers are concerned, two of the biggest beneficiaries in the passenger vehicle space are Maruti and Mahindra & Mahindra. Mahindra & Mahindra will also benefit from its tractor segment. For tractor, current GST rate stands at 12%, and there is an expectation that GST tax rate may be reduced to 5%. Amongst commercial vehicles, Ashok Leyland can benefit the most because almost 90% of their vehicles are in this tax bracket of 28 to 31%. There also tax can be reduced. Why Maruti can benefit the most? Because they have so many vehicles below 1200cc, for which tax can reduce to 18% from 28% plus cess that they have in the range of 1 to 3%. They also have hybrid vehicles in the petrol. So for petrol hybrid vehicles up to 1200cc, for that also tax can be reduced to 18%. Even hybrid with diesel vehicles having 1500cc, for there also tax can be reduced to 18%. What do brokerages believe? MS says they have taken an example of 2008 when government had announced excise cut, rate cut and sixth pay commission that had led to 20% plus demand for autos in the next 2 years, that is in 2009 and 10. They believe that GST rationalization can have a similar move. In two-wheelers, they believe that Hero and Eicher can gain the most, and in passenger vehicles, Maruti and M&M can benefit the most. Nomura believes that tax cut by 10% can improve the demand in the range of 15 to 20%, but this tax cut can be negative for electric vehicles because price gap between electric vehicles and ICE vehicles will increase further. That can be negative for electric vehicles. For Nomura, M&M, Hero MotoCorp, Ashok Leyland are expected to benefit the most from this GST rationalization that Prime Minister Modi has announced in his Independence Day speech.
Okay, all right. So it got that, and the stocks are really showing that excitement and that hope that those lower tax rates will indeed come through. Thank you for that. Let's head to Upasna. She's looking at a lot of the the consumer durable stocks. Upasna.
Well, lower GST rate proposed by the government is expected to spur the demand for consumer durables, especially for categories like ACs and televisions. Now, analysts believe that this rate cut can mainly lead to a positive impact on AC stocks, which is why they can expect nearly 7 to 10% of price cut in the ACs, which is a key positive, which is why the stocks are surging in trade today likely. Now, if we look at the current tax rate, currently within electronics, ACs and large screen TVs, that is above 32 inches, are at 28% GST slab. while other categories such as smartphones, washing machine, refrigerators, microwave, geysers are at 18% GST slab. Now, looking at the brokerages, Jefferies says that the GST rate rationalization is expected around Q4 CY25, and it sees a good chance that the GST on ACs may go down to 18% versus currently 28%. CLSA says that it expects this change to strongly influence the demand for air conditioners, particularly after the recent sign of weakness seen in all these stocks in Q1 FY26. It also believes that this will affect sectors both demand, growth as well as profitability altogether. Kotak believes that the new rates may provide 2.4 trillion boost, benefiting mostly autos and consumer durable sector as a whole. Now, according to the media reports, Harrier Appliances says that any rate rationalization may give significant boost to demand when especially when AC prices are poised to go up next year due to energy rating. And lastly, Blue Star also says that while AC will compete strongly with other categories, it sees a big positive for sales this year time around.
Okay, all right, got that, Upasana. Thanks very much. And indeed, 7% to 8, 9% on many of these consumer durable names, AC makers especially. Well, with that, let's move on. Actually, we've spoken about a lot of the GST impact playing out. Let's also go back to some late earnings that came through and the outlook ahead for some infrastructure companies. IRB Infra is on our radar. In the first quarter, the company saw high single-digit growth in toll collections, while the order inflow was a bit muted. To talk about this and the trends ahead, let's discuss it with Anil Yadav, Director in Investor Relations at IRB Infrastructure. Anil, thanks for joining in. Let's start by the trends that you're seeing in toll collections, high single digits in Q1, whether you expect a pickup and what your outlook is on toll collections for the full year.
Yeah, thank you. Thanks for having me here. With respect to toll collection, we have seen a robust growth for at least for the first quarter, in spite of the June where the monsoon has started a bit early, but there was a healthy growth. And if you look at the July, we have already reported the number that was double digit, 10% growth was across the portfolio. And we are about to start with Ganga project in the second half of the year that will further boost the overall toll collection for the company. So considering the projects, Ganga will be also becoming operational. I expect double-digit kind of growth in the coming months for the overall company.
All right. Hi, Mr. Yadav. Good morning and good to see you in. So toll collection of double-digit is what you're working with. You want to throw some more color? Could it be mid-teens?
I think as of now, we are guiding only double digit because if you look at the first quarter, it was around 8% and we are expecting around 10 to 12% kind of growth in the toll collection on backdrop of the healthy collection what we have seen in the month of the July. And Palchit Dhankuni has also become operational, fully operational in the month of July, and Ganga will become in the second half of this financial year.
Got it. On the construction vertical, earlier I think you were anticipating close to 4,000 crores of revenue. Is that on track? Could you outbeat that? I think for the first quarter you've done around 1,200 crores.
So I think as you are aware that this space will have an impact on because of this in the second quarter because of the monsoon. So typically as of now, we are holding our guidance of around 4,000 crores kind of revenue for the construction segment.
Oh, okay, all right. What about order inflows, sir? Quarter one was a little bit soft. What kind of order inflows are you penciling in for the remainder of this year and for the year on the whole?
Yeah, so if you look at the IRB, we are having roughly 30,000 crores kind of order book. And gradually our O&M order book is consistently increasing, which is 10 to 15 years kind of order, which provides 10 to 15 years kind of order visibility. And in terms of the new addition of the order book, we are transferring the three assets from the private InvIT to the public InvIT, where the private InvIT is expecting to realize roughly 5,000 crores kind of revenue with a 5,000 crores of kind of 5,000 crores kind of cash flow, which will be coming to the private InvIT. They can bid for that. Typically these projects are funded 70-30 debt equity. We can bag around 15,000 crores kind of project with that kind of liquidity coming in. And in terms of award, we have seen a muted kind of award in the till August. We expect that second half may be better in terms of the award.
Anil, this FASTag annual pass that's now active. I think it went into effect from the 15th of August. According to some estimates, and I'm looking at a CRISIL report here, it says that it could have a revenue impact of 4 to 8% on toll operators' income. What is your own assessment on how much it eats into your revenue?
I think one has to look at the concession agreement, and typically the model concession, which prescribes that if there are any changes post the award of the concession, that will fall under change in law, and whatever the losses will be there, that will get compensated under the change in law mechanism, and they will make the concessionaire revenue neutral. So considering that the government has already issued the notification stating that this will fall under change in law, for us it will be a revenue neutral. We will not have any kind of loss because of the implementation of the annual pass.
Okay, all right. So no impact for you. Got that. Can you give us a sense of the overall bid pipeline for you? The opportunities you may be considering via the PPP route going forward? Just break this up. I mean, BOT, really, what will your bid pipeline look like over the course of the rest of this year?
I think in terms of, we'll start with the monetization program, which was scripted in the budget. There was the total monetization for the infra sector was around 10 trillion. Out of that, 3 trillion was allocated for the road sector. So then that was the 4 to 5 years timeline. So roughly 60 to 70,000 crores kind of monetization one can expect on a per annum basis. We have not seen any kind of monetization happening till date. So we expect that their project may be coming in the second half of the year. And there is around 45,000 crores of BOT also there, which is up for bidding. So as and when those opportunity will unfold, we will be bidding for the same.
Okay, all right, Mr. Yadav, appreciate you joining in. Thanks a lot for giving us your take on how the last quarter panned out and the way ahead. By the way, the Nifty is on its way to 25,000. We just kissed that mark a few minutes ago, and the Nifty Bank is participating as well. So it's green on the screen, things looking very, very good. The Nifty is firing, auto index is firing, and the big boy, the Nifty Bank as well, is just moved to around the 20-day MA. So let's slip into a short break. On the other side, we have the management of Nifty Organics that's waiting to detail their past quarter's numbers. Stay tuned. Well, as promised, let's discuss the quarter one performance of Nifty Organics. We have with us Vinity Saraf Mutreja, the Managing Director of Nifty Organics, who joins us on the show. Hi, Vinity. Good morning. Good to see you in as always. Well, before you get to your numbers, just wanted to understand what is your exposure to the United States. Exports are roughly around 55% of the mix. But to the United States, what is it at? And this recent Trump's tariff tantrum, so to call it, it'll have some impact on your business, I'm guessing?
Okay, good morning. Thanks for having me. So out of the 55% exports of our total company, about 33% out of the 55 is to the United States. of which the bulk of it, 80%, is ATBS and related products. So roughly you can say 25% of my revenue, which is exported to the United States, ATBS and related products, which are under exemption from any sort of tariffs. This has been since the case since the beginning of the year. So as such, the impact of tariffs is very little. Coming back to the remaining 5 to 6% of my sales, which is to the United States, there is no manufacturing in the US for those products. And hence, in most cases, either the customer is absorbing the tariff or they're lobbying with their government to remove the tariff. Thirdly, 2 to 3% of my revenue, which is some of the butyl phenols and the AOs, which are under the tariffs. We are still competitive, and if not sell to the United States, we have many other markets, including India, where we can sell that too. So net, there's almost zero to no effect of tariffs on my company sales.
Thanks for explaining that to us, Virati. So you're sounding very, very confident, and you're saying that you're giving us the breakup and not much impact to your business. Take that on board. Let's get back to the numbers then. What led to the margin expansion in this first quarter? And is this sort of a margin performance sustainable? What's the outlook for FY26? We normally ask you for two numbers, margin outlook as well as revenue growth.
Sure. See, the margin expansion, and I've always maintained, it's because the raw material prices came down in Q1 vis-a-vis Q4, and hence you saw that slight increase in EBITDA margin from 26% to 30%. Since we have a quarterly lag in our pricing, I still maintain on average, on a year-on-year basis, 27% of EBITDA margin is what is sustainable for our product mix. Given that this year revenue growth, I do expect 15% revenue growth. Again, volume growth may be 20%, but because the raw material prices are falling and are fluctuating, hence I'm predicting a revenue growth of 15%.
15%. Okay. Vinity, hi. Morning. Just wanted you to address the news which came out yesterday. The anti-dumping duty, which Commerce Ministry said DGTR has recommended anti-dumping duty on PVC. Now, upstream, downstream, is there any implication anything at all, Vinity, for you as a company?
I mean, look, if if PVC imports come down and more domestic PVC is going to be used, then of course the demand for my antioxidants increases in India, which anyways has been increasing steadily over the last 4 or 5 years, and hence we are very positive and bullish on the demand outlook of domestic consumption of AOs in India, because that is primarily it goes into plastics.
Is there enough? I mean, I think Reliance was setting up PVC capacity. Adani's were setting up capacities, large capacities. I mean, will this? In terms of pricing for your products, etc., is there any lift at all because of this?
Well, for pricing on my products, because see, my products, I still compete with China and Singapore. So as such, it is a competitive industry, but the demand is increasing. We are backward integrated. We make our own raw material. We have reached break even in AO. And as the volumes pick up, we will soon see profitability there.
Another aspect, Vinity, again, this is slightly global in nature. In China, I mean, I spoke to this JP Morgan analyst end of last week, who said that across a range of chemical industries, especially polluting industries, China is once again curbing supply. For various measures, buying out capacity, 20-year plus capacities shut down, etc., etc. Have you? They're calling it anti-involution. I mean, basically preventing a race to the bottom across a range of these things. And one of the sectors most talked about is chemicals. Anything you can tell us, Vinity?
See, I mean, look, if it is a polluting process and that is why Chinese industries are shutting it down, then most likely we are not in those chemicals. We are into very specialty niche chemicals with green processes. So hence, this may not affect us directly, what you are saying, that shutting down of polluting chemicals, that will not affect my business.
Vinity, hi, morning. So coming to your capacity expansion, and there's a large expansion at play, right? I think your ATBS capacity will eventually go up by 50%. So where are you in terms of the commissioning timelines of all this? And then what visibility do you have in terms of the utilization of this new capex and overall revenue growth, say, over the next 2 years? Vinity? Okay.
Can you hear me?
Yeah, we can hear you now. Yeah, the question on your revenue growth and the utilization of your expanded capacity, because it's such a huge amount of capacity that you're putting on stream now.
Sure. So the ATBS capacity expansion is happening in two phases. The first phase of 10,000 tons, it's actually completed now in August. We need to take a shutdown to integrate that plant. And since we are oversold on ATBS, it is taking a bit longer. That plant pretty much in the new line over the next 6 months. The second line, the other 10,000 tons will come in at some point next year around April 26.
All right, Vinity, we leave it there. Thank you very much for joining us. Good speaking with you, and indeed, thank you for that outlook. Nikhil Gupta is now joining us. He's India economist at CLSA. Nikhil, good morning. Great to have you with us here. Thank you very much. I think we're speaking for the first time since, in the new avatar, if it's at CLSA. So good to have you on board. And I hope this is the first of many interactions here. Just Nikhil, how are you thinking about you're somebody who's for years, talked about how demand has been a problem, across, and consumption has been a real problem. We've had those around the budget every year. We've had interactions, etc. Will the GST rationalization, in a durable way, lift mass consumption? Actually, forget mass consumption. Consumption broadly across sectors. How do you think about this, Nikhil?
Thank you, Prashant. Good morning. Thank you for having me on the show, and it's nice to connect with you always. Okay, so yes, Prashant, broadly, we have always believed that household finances have been really weak in India, which is going to hurt consumption. And we are seeing consumption growth. We are seeing consumer companies struggling to post volume growth. And if you look at what the government is trying to achieve over the past 2025 year, at least, they started the year in the budget. They announced an increase in the income tax exemption limit, a significant increase, which was supposed to give a boost to consumption. Then we saw a decline in interest rates from the RBI. And now Prime Minister Modi has announced that by Diwali, we will see some GST rationalization. So one thing is very clear, that there is an acknowledgement of consumption slowdown, and the government is trying to address it through various ways. Now, the question is, will GST rationalization help to reverse this slowdown in consumption? It's too early to say at this point in time. We do not know the details. If I just go by the headlines, and if I do a rough calculation wherein we assume that 12% and 28% GST slabs are gone and they respectively move into 5% and 18%, then the calculation suggests that the total loss to the government on an annual basis could be in excess of 1.5 lakh crore, 1.5 trillion rupees, which at this point in time seems too high to believe. We know that the direct taxes has not been very strong, especially personal income taxes. We are going to see the impact of the increase in exemption limit. At the same time, we know that the government is very serious about their fiscal deficit number. So we don't think that fiscal deficit number would be something that would be compromised. Even if there is a shortfall in receipts, it is very likely to be adjusted through lower spending rather than adjusting fiscal deficit. So all in all, broadly, as I said, there is clear acknowledgement that consumption slowdown is there, and the government is trying to address it through various ways. But we must understand that this slowdown in private final consumption expenditure or household spending in general has been playing out for almost a decade now.
Yeah.
Just one thing, you're just sheer numbers. You're saying 1.5. They can't find. If you go by media reports, it basically a little over 1.5 lakh crores. You're saying that can't be found. That money can't be found elsewhere by doing, increasing something. We don't know how, but you don't think there is any room given the state of finances?
No, I'm saying if this is a gross losses, I'm saying the government cannot afford to have these kind of losses at this point in time, because we are already seeing shortfall in the direct taxes. So it is very likely, if we see these kind of losses to the tune of 1.5 or excess or thereabout, the government will try to make up at least a part of that through some other ways. Now, we don't know what those other ways would be. All we are doing right now is speculating on the statements made by Prime Minister Modi on the Independence Day speech.
And Nikhil, just to clarify, the 1.5 lakh crore rupees of loss that you're talking about, that is total loss, states plus centre, or that is just the centre's component?
That's the combined losses.
Yeah. So, would you sort of bifurcate that and give a sense of the centre's share, and then therefore we have to see how much they're foregoing through direct taxes because of the income tax cut, and then through the indirect tax route? How much would be the centre's hit?
No, again, because we do not have the specifics of this GST rationalization, it is very difficult to put in a number. But broadly speaking, we can say it would be 50-50 between center and states combined. And we also need to remember that all the decisions related to GST rates are taken by the GST Council. So states also have the equal say, if not more, in making changes to GST rates. So
the other thing is to take your point. So 50-50, roughly speaking, centre's hit would be about 75,000 crores, and similar for states. The other thing which our colleagues are reporting is that in the new avatar, the compensation cess needs to go. So that little cushion also is not available anymore. So will the set-off really play out? The government's hope is that overall increase in demand will lead to tax buoyancy, and they'll make good most of the 75,000 crores. Do you think that could be a realistic scenario?
I would not go by the assumption that whatever the makeup by higher demand would be more than 75,000 crores. That, according to me, would not be my base case at this point in time. But again, I'm repeating again and again, we do not know exact details. We do not know which items would be affected, which segments would be affected, how much price elasticity would be there, what would be the increase in demand. So it's very difficult to answer these questions at this point.
Yeah. Nikhil, just since we are talking in hypotheticals, and maybe we'll have you, I would love to have you back on later this week when the GOM, etc. is done. You said they'll have to make up this revenue loss through some measures, right? Since we are talking in hypotheticals, what could those measures be?
I would not go into those kind of speculation at this point in time.
No, but broadly, with what you're thinking and how the government is sort of behaved on other taxation, etc., what could it be? Where would they go? Which areas would they go to make up for this, in your opinion?
Very difficult, because first of all, we need to be very clear that 1.5 lakh crore, what I'm saying, this is a very gross number based on very rough calculations. We do not know exactly what would be the losses, what would be the rationalization look like eventually. And you talked about compensation cess. We know that compensation cess is going to expire in March 2026. Now, again, we do not know if it is going to end in March 26 before that, or if it will be extended, because the decision on that is also pending. So a lot of questions are there. It is very difficult, even speaking hypothetically, to answer your question at this stage.
Okay, all right. Hi, Nikhil. Good to see you, Win. We have discussed a fair bit about the GST cuts. I wanted a couple of numbers. One is with regard to the tariffs that are imposed on India by the United States. What would that be? What impact would it have on our GDP, if you could quantify it? Point number one. Point number two is, the RBI has done its share with regard to monetary easing. Do you think we have another rate cut in store in the coming months?
Hi, Nijal. Good morning. Okay, to answer your first question, our calculation suggests that the tariff impact could be as much as 60 bips of GDP growth, again on an annual basis, which means that if the new tariff of 50% comes into play and remains so from the end of this month, then FY26 growth could be impacted by as much as 35 bips. Now, again, this is the maximum impact that we're talking about. There are, again, a lot of ifs and buts. We need to see what kind of changes do our producers or exporters do in terms of finding new markets, how soon they can find it, how soon will the US consumers be able to adjust with some things where India holds some bargaining power in terms of diamond jewelries, etc. There will definitely be some sectors where we'll be hit, and that's why there is no denying that if these new tariff rates remain in place from this month end, we will have an adverse impact on GDP growth. But the total impact, according to us, would not be more than 60 bips on an annual basis.
And
RBI, yeah.
To answer your second question, RBI, again, we have always held since the June 50 bips rate cut by the RBI. We believe that GDP growth forecasts of the RBI in general are still optimistic at this point in time. There is a high probability that GDP growth actual GDP growth would be on the downside, and inflation would also be lower than what the forecast, even the new revised forecast. We are saying there is a possibility that headline inflation, because of food and vegetables in prices, would be lower than what the forecasts are. And if that is the case, we believe that there could be a rate cut, very likely in December. We are still not putting October as our base case, because we must remember that the CRR cut that the governor announced in June, kind of pre-announced, have still not taken into place. So they will start from October and they will continue till November end for 2 months. Sorry, they will start from, right? So once that happens, we believe if the next rate cut has to happen, it will happen only in December, the first week of December, when we have the next policy. That is what our base case is right now.
So December rate cut. Got it. Nikhil, just quick last point on GST again. And we hate to tie you guys up in numbers, but like you gave us that number for tariffs. Tariff impact is roughly 35 basis points of GDP. Now, this GST cut, if it materializes in the current form that is being discussed, is there any estimation? Could it boost GDP growth by, I don't know, 30 bips, 40, 50 bips, or maybe credit offtake by any certain measure? Any such formula that you've been able to work out?
Not done right till now. So because, see, the impact will be huge. First of all, we need to be very clear about what kind of government losses will be there in terms of the receipts. Then if the government makes some other adjustments in order to make up for those losses, we know once we know the items which are moved into what, then we would have to have some impact on inflation as well, which definitely would give some boost to consumption. And that is when we'll be able to do some calculations on consumption and GDP growth. At this stage, I'm sorry, I do not have any specific answer to give you on this.
Okay, always cautious and held back with, and that's the way to go, right? I mean, instead of jumping and putting out specific numbers when we don't know. Thank you very much, Nikhil. As I said, hope this is the first of many. Appreciate your time here on CNBC-TV18. So that's Nikhil of CLSA with perspective on the GST announcements. Let's get you some insights from Mahindra & Mahindra. My colleague Shivani spoke with Rajesh Jejurikar of the impact of rare earths crisis. Listen in to what he had to say.
Yeah, Shivani, we spoke about this a couple of weeks back after our earnings call, and we said at that time, and I have no new update, that we are covered for Q2 and Q3. We have a couple of components, a few components to address in Q4, and we have a reasonable path. And we put in multiple mitigation actions, which I wouldn't go into detail of.
Okay, and Mr. Jejurikar also reacted to Prime Minister Modi's announcements of GST reforms coming up around Diwali. Take a look.
You know, the thing about gifts is you should accept it with grace.
Absolutely.
And let it be a nice, pleasant surprise.
Yeah.
But I would just add to say that, automotive is a very key sector in India. It's a GDP multiplier. It's an employment multiplier. And with the kind of technologies we are developing in India, there's a huge opportunity for Make in India for the world. And a key part of Make in India for the world is about how much you can sell in your own home country.
Absolutely.
The more you sell in your own home country, the stronger you become. You start getting economies of scale, which allows you to be more competitive. The supply ecosystem builds up. And like I said, it's a huge employment generation as well.
Okay, well, those are some comments coming in from Rajesh Jejurikar of Mahindra & Mahindra Group. We'll take a quick break here. Manisha focuses on commodities on the other side. Stay tuned.
Welcome back. By the way, I hope all the Mumbaikars out there are staying safe. Our colleague Santya has just told us that the warning for Mumbai has now been elevated to red. It was orange up till now, but now it's a red alert. I think up till 12 o'clock. That's what the latest is. We'll put out those comments in just a bit. But we have Manisha joining in with the latest from the commodity markets. Manisha, what's hot?
The crude is really because, and not because it's boiling hot, but because it's continued to extend declines on the lower side. Well, last 2 weeks actually have seen declines in crude oil prices. And with that, we're down by 10% for the month of August. We are down 13% for 2025 till time. And we are also trading at 2-month lows in the international markets there, with 62 for WTI and 65 for the Brent crude oil prices. So it has been a sharp decline over the last couple of weeks there. Well, interestingly, it is the higher supplies in the global markets. The U.S. production is near record highs. The U.S. inventories have been rising as well. OPEC has increased production until the month of September. So you are looking at enough and more supplies there. Apart from that, it really is about the U.S. and Russia meeting, which has failed to get us a ceasefire. But a peace deal is what markets really seem to be talking about right now. And Russia, in the meanwhile, has asked for Ukraine territories. More conversation on that is expected today as the U.S. president will meet presidents and head of states from NATO, France, European Council as well, and then Ukraine, France, etc. So that meeting is something that the street will keep an eye on. Just to take a step back and give you through the timeline, really, when it comes to the Russia and Ukraine conversations there, we already have had the US, UK, European Union prohibit import of seaborne crude oil in the first year of Russia-Ukraine war itself. And that is the reason much of this crude started to flow into Asian countries like China, Turkey, India, etc. So much so that India was buying 40% of its crude oil from Russia in the last couple of years. Adding to that, you also have the G7 countries imposing price cap on Russian oil at $60 in December in 2022. They have tried to revise it much lower to almost around $47 a barrel as well, but there is no backing from US and we haven't seen that implemented because of that. The other thing really is about sanctions, not just on the crude, but also on Russian companies, individuals, insurance, fleets, etc. There also are secondary sanctions in place, especially with India bearing the brunt of it, where 25% additional would come in from 27th of August if more negotiations do not go through. Interestingly, when you look at the Chinese data, all of that has come in on the weaker side for the month of July. That seems to be weighing onto the crude oil prices as well. So whether it is about July industrial production, the retail sales data, the new home prices, it is lower on a month-on-month basis. It is also lower on an estimated basis as well, and lower as compared to previous year also. So that doesn't augur well for many of these commodities, which actually have started Asia on a weaker note today. And when you talk about the outlook, well, that seems bearish as well, because most of these banks and brokerages are talking about lower crude oil prices. 60 to 66, as you can see on your screen. Goldman Sachs also has revised its 3-month target for the crude oil prices. It does believe that 66 of an average is what you could see. But apart from that, it really is about 60, 62, 65 is where we could be looking at the crude oil prices going forward. There's HSBC talking about 68, 60 from USIA, and ETO market says that sub-60 kind of levels also could be seen. If there is some patchwork done, if there are some resolutions coming in, things are sorted, you could be looking at sub-$60 as well by the time we end this year.
All right. Manisha, thank you very much for that. That's commodities in focus there. We take a break. Special Indianomics segment coming up with Lata talking about the impact of the S&P upgrade, tariff hike, GST cut on the economy and bonds. And she'll be joined by Neeraj Gambhir of Axis Bank, Sonal Verma of Namura, Kanika Parishya of Union Bank, and Sameer Narang of ICICI Bank's Power Pack lineup on the other side.
welcome to Indianomics. The Independence Day weekend has been momentous for the Indian economy. Eventful, perhaps, is a more correct word. On Thursday, even before the weekend started, S&P upgraded India to BBB, one notch higher than investment grade, the best grade we've got so far. On Friday, the next day, that is, the Prime Minister announced that GST rates would be cut by Diwali. And over Sunday, it happened after all, albeit for a short time. What does all this mean for the economy, for bonds, and for the cost of capital for companies, for their appetite to invest? I have with me ace banker and bond expert Neeraj Gambhir, Group Executive and Head Treasury Markets and Wholesale Banking at Axis. We have also got economist Sonal Verma, the Managing Director, Chief Economist at Nomura. We have Kanika Pasricha, the Chief Economist from Union Bank, and Samir Narang, the economist from ICICI Bank. Ladies and gentlemen, thank you very much indeed for your time. Well, first let me get the macro picture, then we'll get to the bond picture. Sonal, the rating upgrade and the GST cut consumption boost. One is a capex boost because it brings down the cost of capital. One is a consumption boost. Are you changing your macro growth numbers?
No changes as of now, Lata. I think there are lots of moving parts. The rating upgrade, of course, is an acknowledgement of what's been going right in India. So it's a sentiment booster, might lower the cost of capital for some companies. But in terms of a substantial change in capital flows, etc., I think there are other factors that are offsetting that. The most important being the US-India trade talks and the likelihood that the higher tariff rates are likely to stay for a while. So the impact of that on exports and investment is something which we will see September, October onwards. The GST is a positive surprise. I think typically what we've seen in the past when such tax cuts are announced is that consumers postpone their consumption decisions in anticipation of lower prices. So we could see a softer patch in terms of durable consumption in the run-up to Diwali and a bigger boost after that. So on net, lots of moving parts. As of now, we are still at 6.2% for FY26, and risk we still see skewed to the downside.
Okay. Kanika, your views? Overall, there is a negative from the tariffs probably for some time, but a positive in terms of consumption boost. Where do you stand in terms of growth?
So, Lata, I completely agree with what Sonal said. There are a lot of moving parts, which is why we never changed our growth forecast as well. We maintained it at 6.3% from the start of the fiscal year.
Okay.
While 30 basis points is a direct estimate impact of that 25% tariff hike, we would also want to await the GST booster shot coming in the form of consumption once the taxes kick in from Diwali. But yes, details awaited A, and B, on tariff talks also, whether any penalties are imposed, because there are also news that the US authorities are not coming to India. That needs to be closely watched. So yes, moving parts, but I would just want to add one thing. Maybe from growth perspective, there is a sentiment hit of these tariffs. So maybe the growth impact is delayed from these positive stimulus measures, but direct inflation impact may kick in from December quarter itself. It should be a positive to watch. Thanks.
Fair enough, of course. Samir, your thoughts? I mean, people were talking about a 0.6% or 0.4% GDP impact even when it was 25 basis points, the tariff hike. Now, 50 at least for some time is a possibility. So what, do you leave your growth numbers unchanged?
No, I think, Lata, when we started the year, we had downgraded the growth estimates because of weak growth outlook. Then we upgraded after the front loading of monetary policy. And post the incremental tariffs, now we stand at 6.3%. We've lowered them a tad bit by 10 basis points again. Now, both these events of higher tariffs, as you correctly mentioned, the overall hit of 50% tariff for part of the year will be lower. For a 12-month rolling basis, of course, the number that you mentioned will be on the higher side, maybe 0.7, 0.8%. But there are a lot of mitigants, as we see. And one of them is the GST announcement that has happened. That is one. And the second thing is that, even in case of China, where tariffs have been very high, re-exports have happened from other geographies. So it is very likely that in India's case, at least for the larger set of producers which are part of the supply chain, be it for gems and jewelry and even for textiles, there could be re-exports happening from other geographies. But for MSMEs, the impact would be larger. So on an overall basis, our sense is that the optical hit looks much higher. The eventual effective hit will be perhaps half of it. So our number is around 0.4% of GDP.
Okay. Well, the point is it may not be very growth positive considering so many factors may cancel out one another. But it's certainly a stock market positive because the GST and the income tax cuts are going to be EPS accretive for sure. And most important will be the cost of capital. To you, Neeraj, are you expecting we already saw a steep fall, a good, 7-8 basis points fall in bond yields on Thursday itself because bond markets could still take advantage. But today the yields have gone up from Thursday lows because of a feared fiscal impact. So net, do you think cost of capital goes down for companies?
Sentiment-wise, it's very positive. I think the S&P rating upgrade was a bit of a surprise. I don't think anybody in the market was expecting for it to happen now. If anything, there were expectations maybe next year we could see a rating upgrade. But the fact that it has happened now is obviously a positive for the sentiment in all the markets. The impact on flows will be a bit muted at this point in time, given the other macro variables, particularly on the trade side, has been mentioned earlier, they play out. Bond markets, I think for now, have taken about 5 basis point net gain over yesterday and today, or the previous business day and today. I don't think we materially change from here unless and until some of the other things play out. The tariffs, playing out will have a bearing on the currency, which eventually will have a bearing on the flows. And therefore, I think that market will wait for some of these issues to be sorted out before, changing the direction.
Okay. But what about, your own sector, Neeraj, along with the sovereign rating being raised, all financial institutions' ratings are also raised, those that have a global rating, like State Bank, etc. The rating has already been raised. Likewise, we already hear that a lot of NBFCs are beginning to raise global capital since it becomes a tad cheaper. Can we say that the financial sector as a whole is likely to get slightly cheaper capital than we expected, say, up until Wednesday?
So not everybody in the financial sector is borrowing externally. Some of the public sector banks borrow externally to fund their offshore locations. And we have seen about 10 to 15 basis point tightening of the spreads in the dollar bond market since the rating news has been announced. As more and more of Indian companies, including the NBFCs, tap the overseas market, given the fact that we now have a BBB rating, will certainly help them raise higher amount of funding at a slightly tighter pricing. So yes, net, to the extent that financial sector is borrowing from external world, there will be some benefit in terms of pricing.
Yeah, actually, in our zest, we are forgetting, look at the way the financial stocks have moved today. This morning, Bajaj Finance, Sundaram Finance, Chola, M&M Financial, Shriram Finance, all of them up between 3 and 6%. So clearly they see a cheaper cost of capital coming their way. Will that, PFC, REC, I think will be the biggest beneficiaries because they are always borrowing abroad. You don't see any capex impact of this, Neeraj?
I don't think rating per se impacts capex. Rating, as I mentioned earlier, that improves the sentiment. Okay. It makes it easier for the financial institutions to lend to the companies in a country, particularly the external world. But I think capex has several other dimensions to them. And I think at this point in time, the tariff-related uncertainties are the bigger play. And once they are sorted out, only then I think the capex cycle can have some positive impact.
Okay. Let me toss that to the economists. Sonal, what's the sense? There is this expected consumption boost, especially cement. It's been at 28%, and there is a very good chance it's going to come down to 18%. Likewise, small cars, two-wheelers, very clearly those are... would that trigger a capex boom as well, considering that the cost of capital is going to fall? Not boom. Boom is a strong word, but it trigger capex.
I mean, I think in the overall scheme of things, Lata, right now, first and foremost, we need to see certainty on demand, both in terms of consumption demand certainty going forward and visibility on external demand before that triggers any capex boom. What the GST cut does is it will bring down the price of items that are considered more essentials in nature. And so to that extent, there could be some boost at the margin to consumption demand. Although, as I mentioned, most of this will come after Diwali. We could see some moderation ahead of Diwali. The more fundamental drivers of consumption ultimately will be the ones to watch, what's happening on job creation, how are wages and salaries moving. Lowering prices is one of the factors that drives consumption, but of course not the only one. Similarly, on the exports, things look like we are going to see a moderation in our exports to the US. So I think it will take a bit of time for us to basically say that capex revival is here.
Okay. Actually, I forgot to ask you all the other big question, economists. What about the fisc, yaar? Sonal, would you think that what S&P is giving us in one hand, we may be losing by increasing the fiscal deficit?
We don't know, Lata. I think everyone's jumped to the conclusion that this is a massively fiscal expansion, but we don't know exactly what the fiscal impact will be. While bulk of the items are moving to the lower tax slab, what the revenue share is, so not the volume, but the revenue share of those items is also important because states will not want to lose any revenue from any GST rationalization. So if we are moving more items into the lower tax bracket, but some big revenue contributors to the higher tax slab, the net fiscal impact actually may not be as negative as is being feared. It will still lead to disinflation because the share of these essentials is a bigger share of the overall CPI basket, but it may not be as negative on fiscal is our sense.
Okay, but the market, probably the bond yields have moved up out of fear that there can be some kind of fiscal impact as well. But there are more questions. There was an expectation that the fiscal room available, elbow room available because of the big RBI dividend could be used for a package for the exporters who are reeling under that 50% tariff. Maybe it will be for 3 months, maybe for 6 months, but that handholding is needed. Will that package come? All those questions to my guests after a break. For Bazaar viewers, you can see the rest of the show at the end of the trading day. But we continue with our conversation after the break.